All right, let's talk about a question I see pop up all the time. It's a huge one, a really high stakes question that gets right to the heart of what it means to have conviction. Should you go all in on Bitcoin? We're going to dive into this because the answer is probably not what you think. So there it is, the big one. Should you put 100% of your money into Bitcoin or 80% or 50%? What is the magic number? It feels like this massive decision, and the pressure to get it right, it's just immense. But here's where things get interesting. To answer that very modern financial question, we're actually going to take a step back. We're not starting with charts. We're not starting with market analysis. We're going to start with a story about Mozart. Okay, so the story goes like this. A young, aspiring composer comes up to Mozart and asks him for advice on how to write a symphony. Mozart kind of gently tells him, "You're too young. Start with something smaller." And the young man gets defensive, right? He says, "But you were writing symphonies when you were 10 years old." And what Mozart said back, well, that's the key to this whole thing. He replied, "Yes, but I didn't run around asking people how to do it." Think about that. The point is, if you still feel the need to ask for permission, if you're looking for someone else to validate your decision, you're not there yet. You haven't built true conviction. And that's what this is all about, right? The principle of conviction. The goal isn't to land on some specific percentage that someone else gives you. The goal is to build your own understanding on a foundation that's so solid it's like stone, not sand, a foundation that doesn't wash away the first time a big wave of doubt or market volatility hits. So how do you know? How do you know when you've actually reached that point? Well, it's a total mindset shift. It's this deep, fundamental change in perspective. You'll know you're there when you're lying awake at night, and the thing you're worried about isn't Bitcoin's price dropping. No. The thing you're worried about is how much of your wealth is still sitting in fiat currencies, dollars, euros, or in stocks and bonds. That's when you know. Now, I know that can sound a little abstract, so let's make it real. Let's look at a case study from the source material and see what this journey to 100% conviction actually looks like for a real person. So for this investor, the journey started by looking at all the other options and just picking them apart. Rental houses, they were seen as these constant headaches with leaky roofs, bad tenants, just endless maintenance. Bonds and treasuries, well, they were a guaranteed way to lose money because the yields they paid were way below the real inflation rate. Gold and silver, just shiny rocks, really. And stocks, described as debt in the water, just not a solid foundation. And this timeline is so important because it shows this wasn't some lucky one-time bet. This was a process, a conviction that was seriously tested. He started buying in 2019. He kept buying all the way up to the peak in 2021. And here's the kicker. He kept on buying all the way down to the market bottom in 2022, selling off those other assets to get more. That's conviction. And get this, it wasn't just about the money in his portfolio. This commitment went so much deeper. He changed the entire name and focus of his business and his popular YouTube channel. I mean, think about that. He alienated thousands of followers who were there for stock tips. He basically put his whole life on a Bitcoin standard. But why? I mean, why would anyone do that? What could possibly lead to that level of extreme, life-changing conviction? To get it, you have to understand the foundation of the whole argument. And it's not just a case for Bitcoin. It's a deep, fundamental case against the traditional financial system we all live in. And a huge piece of this puzzle is understanding the risk that's already baked into the banking system, specifically the difference between a bailout and a bail-in. A bailout is what we're used to hearing about. External money, usually from the government, comes in to save a failing bank. But a bail-in, that is a whole different beast. A bail-in uses the bank's own depositors' money, I'm talking about your savings, to rescue itself. And if you're thinking, oh, that's just some crazy theory, it's not. It has happened. And the source material points to a really stark, real-world example from a developed first-world country, the banking crisis in Cyprus back in 2013. That crisis triggered a massive bailing. So what happened? Billions of dollars in regular people's savings were just confiscated, wiped out, to prop up the banks. If you had an account with over 100,000 euros, you lost around 45% of your money. It wasn't moved, it wasn't frozen, it was taken. Gone. But here is the part that will absolutely blow your mind. When the savers who lost their money sued, the court ruled against them. And the court's reasoning was that they had not succeeded in demonstrating an infringement of the right to property. Let that sink in. A court essentially said that the money you think is your property sitting in your bank account, it's not absolutely yours in the way you think it is. So you have that sudden catastrophic risk, but then there's also the slow, quiet, guaranteed loss that comes from inflation. Even the world's reserve currency, the US dollar, has been a melting ice cube. Since 1970, it's lost over 84% of its purchasing power. To put it another way, a dollar in your pocket today buys what about 15 cents bought back then. It's a guaranteed loss over time. So when you put all of this together, the acute risk of something like a bail-in and the chronic slow decay of inflation, it brings us to this final incredible inversion of the whole argument. It takes that standard financial warning we've all heard a million times, and it flips it completely on its head. For years, the warning has always been only invest as much in Bitcoin as you're willing to lose, right? But from this perspective of total conviction, that warning gets reframed. The truly risky asset, the one that is absolutely guaranteed to lose its value over time, is fiat currency. So the real question becomes, how much of your wealth are you willing to lose by keeping it in fiat? And that leaves us with one final question to think about, a question that brings us right back to where we started. It's not about what percentage you should buy or what other people are doing, it's about your foundation. Is your financial life, your money, built on the shifting sands of a system you don't control, or is it built on the solid stone of your own deep, unshakable conviction?